Hi, I'm Jonathan Gurney, Portfolio Manager at Gurney Financial. The purpose of these videos is to educate and keep clients aware of what is happening throughout the week in the stock market. Our goal is to close the gap in communication between clients and the actual person managing their assets. We use fundamentals primarily and technicals as part of our analysis. We hope the charts and education help clients and viewers alike. Friendly reminder that these videos are not to be taken as financial advice. Should you have questions, feel free to reach out to us through email, social media comment section, and make sure you subscribe to our YouTube channel as you will be informed when new material comes out. Let's get into it. The week was interesting, needless to say. It was a short week, but it seems to be the way it works. Short weeks tend to seem and feel like longer weeks. Today, the non-farm payroll data did come out. It was lower than expected. Market really didn't show us clues up or down either way. It was a pretty flat day in general. Honestly, it's kind of understandable that, the unemployment number has been so good consistently that a little miss here should not derail us, and it didn't. So that's good to see. At 12:30, the Fed essentially reaffirmed what we already knew. We have a strong consumer, but the Fed wants to get ahead of potential headwinds caused by the potential trade war which we are in currently. Fed essentially said they plan to cut as needed and will continue to reduce as necessary, essentially. The reality is, what are they supposed to say? They also alluded to the fact that they don't see a recession in the data. We don't, but realistically, what are they supposed to say? But we really don't see it either. And we, again, short term, we're a little concerned with where we are, current levels. Midterm, I do believe higher highs are likely based on the data that I'm seeing. Powell claimed that trade uncertainty is weighing on business, investment, and confidence, but it was good to see record number of companies borrow in the U.S. investment grade bond market this week. Businesses want to borrow at these rates, just like a homeowner wants to refi while rates are low. These are good for companies, good for individuals. Before I go over any analysis, I want to make sure that clients, specifically the people that I work with, understand our current situation. This does not apply to everybody. This is mainly a growth portfolio. Not everybody is in the growth portfolio, but if you're in our primary growth portfolio, we are currently up since May 19th, 2017, over 43%. The S&P during that period, again, since May 19th, 2017, so a little over 2 years. In a couple months, the S&P 500 is up 29.1, so 43 versus 29.1. In short, we had a little bit of a buffer that we could work through and be willing to take some off the table, even if we miss out on some upside gains. Sure, I never like to see us missing out on some of the potential gains that were had, but we did. We missed out on about 2 to 3%. It's unfortunate, but these are the times where you'll hate me short term, but long term, I'm not worried about playing catch up there. So for the year, we're trailing the S&P 500 a little bit. But overall, since the inception of this fund, we are undoubtedly beating by quite a wide margin. And I want to show that to you. So here you go. So here's, again, ignore the title. We have much more in here beyond artificial intelligence. But we are very conservative in this at this point. The green is the S&P 500, 29.1 versus the 43%. You can see, like, if we went to the 1 year, it's right at 3% difference. So you see I backed off here and it's basically flatlined. I do expect a little bit of a dip here shortly. Who knows if it will happen? We're starting to see some good technicals. Let's go over the pros and cons list, and then we will get back into the charts. Our conservative portfolio is actually doing quite well. So that's good to see that the people that need the income are getting it still. That portfolio has done quite well. So for clients that have joined in the past year, hang in there. I know it's a little frustrating that we're underperforming by a couple percent short term. Really, we were outperforming until this week, until I backed off. So frustrating from my point. I'll apologize there. The market is difficult to perfectly time, and I'm never going to time it perfectly, but long term, I probably will outperform as shown in one of our growth portfolios. So short term, a little concerned. Midterm, like where we're likely to go. but still. But I hope this helps. I wanted to give you the real perspective to show that I'm not winning all the time, but there are times where it's like a 50-50 chance could go either way. And if I'm outperforming that much, it's usually wise for me to back off. And what I want to show you is kind of the performance first, and then we can kind of go from there. So let me transition 1 second. Let me get where I need to go. All right. There we go. All right. So here is intraday sectors. So energy, materials, on down the list. We usually show this to you every week. Wasn't much told to us today. In fact, many of the areas you want to see doing well, the risk on areas showing a turnaround, getting out of conservative areas, just did not happen today. We saw a little bit of that during the week, which was good. We saw it on higher volume, which was also good. That has not been the telltale in all cases during some of these rallies. It's been low volume, and I've been hesitant to get in. So let's get into the charts and pay attention to a few of the things that we've been watching. We've been saying for quite some time we want to be watching a few key areas, and we're going to hit those right now. So key levels in the S&P 500, hallelujah, we got out of the trade range. We got out of the 2800, which we've been highlighting for a while, to the 2940 range. Right here, you're seeing this consolidation for a solid month. Makes it seem like the world is ending, and boy, did the news publicize that. All recession talk was basically, 3 to 4% off the highs. But right now, as of close, we are about 1.5% off all-time highs. So relax, people. We're hanging in there. The market is not an indicator for recessions, though I'm not seeing it in the data at this time. Could it happen in 2020? Maybe. But I will see indicators that will likely push me to get out a little bit ahead of that, kind of like I did last week. It could have gone either way, and without performance, I'm going to do that in most cases. You'll hate me for it this time, but next time it could easily go the other direction. Not in love with this candle. We tested the 2980 level both days. This was Thursday, this is Friday. You see Thursday, this was good on volume. I'd like to see it. End of summer is not ideal for volume. Don't like to see that. But this was a pretty decent day on volume, on risk too. So that was good to see. Today was not exactly ideal. Not a great day. But the RSI did hold the 50-day moving average. That was good to see. Let's move on without getting into it too much. The PMO, seeing this crossover is not a bad sign either. So fundamentals this week realistically are doing quite well. This is what we wanted to see. A lot of things that we were hoping for are happening. This is kind of a chart that I posted midweek. Is the 6th time the charm, and it was. We got the trade news basically saying we're going to meet with China in October at some point. What's amazing is that is what did it. I wish it was something more concrete, but I'm not sure. The president tends to be, he tends to play hardball when we are at a near all-time high. So I get a little bit cautious here. I'm not cautious at all-time highs because we're at all-time highs. Because again, look through here. I mean, this is an all-time high. These are all all-time highs. I mean, this happens consistently throughout the market. So if you sell at all-time highs, you're missing out. But in this case, I've just seen time and time again, we get to these levels and the president uses it as leverage to say, okay, we can go down a little bit. Let me try to get a little more in trade. Boom, we trade down and go up. It's probably going to happen again. I can't promise that, but who knows? It'll be interesting. Be open mind to that. Don't lose your mind if we test the 50-day moving average again, which is the 2946 level, 2946 right there. Okay. Don't be surprised if we see that. Another good thing, well, kind of in between realistically. Again, we bounced off these levels on the Russell 2000. We are seeing extreme weakness in the Russell 2000, which is not good, but we did bounce off the lows. Again, this is the month of August. We tested the lows, bounced off like I said it probably would, But here's the problem. We, for the last 2 days, stalled right at the 200-day moving average. Eventually, we'll probably get through that. But what I like to see in a lot of these areas, a little consolidation first. Yes, most analysts would like to see that. I wish we would have tested the S&P 500 level, 2,800 right here. I wish we would have tested this at the 2,800 level, basically the 200-day moving average at that time, because again, you're going to have a hard time seeing bears funnel money in. Again, I'm bullish midterm, but I am very cautious short term because of outperformance, and I'm not seeing a lot of the areas I want to see do well. A lot of the momentum areas are not really doing that well. That's a concern. We want to see assets shift out of conservative areas and go into more risk. I'm not sure we're going to get it though. So I will invest accordingly, obviously, but those are the concerns that I have. Same thing as the Russell 2000. The TRAN, we tested key levels, bounced up. Problem, we can't get over the 50-day moving average. That is concerning short term. Might test a little lower and probably go higher, but who knows? I'm not seeing the risk reward 1.5% off all-time highs. A lot of analysts say, hey, free range if we hold the 2980 level going to 3027 all-time highs. After that, people are basically probably going to sell again. I just don't see much movement above that short term. I think a little lower testing might be useful to bring more monies into the market. We've talked about this, low beta versus high beta. Look at the difference, the 1-year performance in low beta, meaning lesser risk, 16.87 versus higher risk. That is interesting. Okay. So do I see opportunity in like tech? And understand that tech stocks, some actually do have decent dividends anymore. That is something that has changed in recent years. So that is a huge spread. I would like to see some of the areas like utilities and some of these other areas chill out a little bit and shift some of these higher beta areas and push us higher in general. So it's interesting to see high beta, S&P 500, low beta. Just kind of interesting to point that out. Copper, kind of same story as with the Russell 2000 and the TRAN. We tested low levels. It held, and we once again cannot pierce through the 50-day moving average. It doesn't mean we won't, but I just want to see a little testing lower to hopefully get some people on board. You have a lot of people in the realm of fear of missing out. They are hoping for a quick dip and will pounce. I wouldn't be surprised to see opportunity on a dip. That might be good. Put call ratio. This week we saw a level of 183. It actually might have been last week. I'm not sure when that was. I'm losing my mind a little bit because I've been in charts basically all night. So that is this is basically a contrarian perspective, meaning people are protecting their portfolios. This is a very high number, as you can see, in perspective to the other highs like 173 and so on. If you go out further, obviously, but in this range, this is a high number. In short, saying there's a lot of fear, it might be a good time to buy, and it was, as you can see, right around here, the S&P 500 pounced up. So we got out around here, just say, hey, I'm fine with that. I might miss out on some, but it could go either way. So that's the decision we made. It was unfortunate, but we are still beating the S&P 500, especially since the inception. Short-term clients that just joined, it's a little frustrating, but we'll be okay. I like the position we're in because we can pounce at any time. This is kind of to show you an interesting perspective. Many people are like, oh, I need to be in bonds to be conservative. Guys, the 30-year yield or a 30-year bond is it's not yielding much at all. Would it be better to have something like a Verizon? This is not a recommendation to buy Verizon, but it's interesting. It's just to help our viewers and understand there's a reason why people are fleeing to these areas and why these areas are doing well. And that's because of, they have higher dividend yields than the yields that's producing by most of these most of these bond areas. So, I mean, I like the possibility of higher growth and a nice buffer of 4%. I mean, these are the areas that might get even more traction. Things like Home Depot, Lowe's might get the same traction. We'll see. It might be a little bit overbought short term. One other thing that I wanted to show and bring up was the difference between 2018 and 2019. And this is important. This is why a big reason why I got out and just said, hey, this looks pretty similar to things I've seen in the past. It could go either way. It went the opposite direction, which is good. Again, I was honestly saying this could happen and could go higher. These are the things I want to see at that point. I'll get in. So really, 2018, I said in our notes, which you can see on the right-hand side, one of the first topics that I'm not sure I really touched was 2018 up to October was like a 12 to 16% year for me. And then look what happened across all asset classes. Again, you're talking large cap, small cap, emerging markets, bonds, REITs, gold, commodities, everything. The only thing that did well was cash, which is very rare to see all red in a year. Like even during the Depression, you saw some green. Where I am concerned is we're seeing year like kind of like a 2017 where most asset classes are rallying together. I mean, if you're in gold this year, you're good. If you were in silver this year, you just had a huge rally. If you were in bonds this year, you did fantastic. If you were in stocks, large cap, you did pretty well. The only thing that hasn't done great is small caps. But still, the point being, 2018 was the year everyone lost. 2019 is a year where everybody has won. You just had to be in the market somewhere. So the point in this is I was seeing a lot of like a 2017 where there was virtually no volatility, different environment. I get that. But a lot of the asset classes were rallying together. And I'm saying either people are going to get out or it needs to shift asset classes. So from conservative to higher risk, the opportunity is likely in higher risk, but I'm not seeing the shift yet. And that is a concern. So that you're seeing why I'm a little bit concerned short term. So to conclude, let's wrap this up. In short, there's really a tug of war going on. There's pros and cons, bulls and bears. This is normal stuff that's going on. Midterm, I believe the move is higher. But I, like many other analysts, believe that some lower testing might be needed. I think this would be so good for the market because it would bring more people in that are saying, I'm not going to chase this. So that's just my perspective. It doesn't mean it's right. We're seeing a lot of good technicals, a lot of good things that I'm seeing that might hold us up to all-time highs. Past then, I would be really cautious, not because of the all-time high number, but simply because technicals over the next 2 weeks, the next Fed meeting is September 18th. So over the next couple of weeks, technicals are really all we have left to pull us higher. There's no real earnings, and it very well could push us higher, which would be fantastic. I'm a little concerned that I'm still seeing a lot of buying go in to bonds and fixed income areas and corporate bonds. We did see some outflow in consumer staples and utilities, which is good. But seeing the XLU utilities being 19 times earnings is ridiculous. It should not be that high. I expect a shift out of there. The question is, where are they going to put it? Corporations, institutions, I'm not seeing any sell-off there. They're holding firm, and as proven over this last month. So I hope this helps. As always, we look forward to giving you a balanced approach, the good and the bad. Every day in the market presents new learnings, and that is something that I take very serious, and I want to preach that and make sure my clients understand that I am on the ball. I'm not going to get it right every time, but you will know that I am paying attention to this stuff. So we'll keep an eye on it. We'll keep you apprised, and have a great rest of the week. Hope you can enjoy it. We'll be watching, and eventually these videos will probably be, this is actually done live, not edited, but look forward to the time where we can do this live. You can actually send comments during the video and so on. That'll be pretty cool. So look forward to that. But thank you again so much for your time. Have a great rest of the week, and we will keep you apprised with what's happened in the market. Thanks again. Have a great